I have a confession to make. Some of the wealthiest people I know, people worth hundreds of millions of dollars, even billions, they did not get rich during bull markets. They got rich during crashes. They got rich when everyone else was terrified, when the headlines were screaming about economic collapse, when ordinary investors were selling everything and hiding in cash. That is when fortunes are made, not in the good times, in the bad times. And I am going to tell you something that might sound crazy given everything you are hearing in the news. The next market crash, whenever it comes, is going to create more millionaires than the last 10 years of bull market combined. I am not saying that to scare you. I am saying it because it is true. And if you understand why, if you prepare properly, if you have the courage to act when others are paralyzed by fear, you could be one of those new millionaires. I have been through more market crashes than I can count. The crash of 1987, when the market fell 22% in a single day, the dot-com collapse when technology stocks lost 80% of their value, the 2008 financial crisis when the entire global banking system nearly imploded, the COVID crash when markets fell 34% in just 23 trading days. Each one of these crashes felt like the end of the world while it was happening, and each one created enormous wealth for investors who kept their heads and bought when everyone else was selling. Let me tell you how this actually works, because most people fundamentally misunderstand what happens during market crashes. When the market crashes, stock prices fall. That is obvious. But what does a falling stock price actually mean? It means you can buy ownership in real businesses, businesses that generate real profits and real cash flows at a discount to what they were selling for before. The business itself has not changed. Apple is still Apple, Microsoft is still Microsoft, Johnson & Johnson is still Johnson & Johnson. But the price you pay to own a piece of these businesses has dropped dramatically. This is the key insight that separates wealthy investors from everyone else. They understand that stock prices and business values are not the same thing. In the short term, stock prices are driven by fear and greed, by momentum and panic, by factors that have nothing to do with the underlying business. But in the long term, stock prices converge to business values. A great business bought at a cheap price will eventually be recognized by the market, and the price will rise to reflect the true value. During crashes, you get the opportunity to buy great businesses at cheap prices. This is the closest thing to a guaranteed path to wealth that exists in investing. Not timing the bottom perfectly, not picking the exact stocks that will recover fastest, just buying quality when it is on sale and waiting for the market to recognize the value. Let me give you some specific examples from my own experience. In 2008 and 2009, the financial crisis was the worst economic disaster since the Great Depression. Banks were failing, credit markets were frozen, people were talking seriously about the collapse of capitalism itself. The S&P 500 fell 57% from peak to trough. If you had $1 million in stocks at the peak, you had $430,000 at the bottom. Devastating. But here is what happened next. If you bought stocks at the bottom in March of 2009, even if you just bought a simple S&P 500 index fund, you made 500% over the next decade. 500%, $100,000 invested at the bottom became over $600,000. $1 million became over $6 million. That is how millionaires are made. And it was not just the index. Individual stocks did even better. Bank of America, which fell to under $3 per S-share during the panic, eventually recovered to over $40. Apple, which fell 50% during the crisis, went on to become the most valuable company in the world, returning thousands of percent. Amazon, which fell to around $30, eventually hit over $180 even before adjusting for stock splits. The investors who bought during the crisis, who had the courage to act when everyone else was frozen with fear, they became wealthy. Not because they were smarter, not because they had inside information, simply because they bought when prices were low and held until prices recovered. The same pattern repeated with COVID. In March of 2020, the market crashed 34% in less than a month. The economy was shutting down. People were dying. Nobody knew how long the pandemic would last or how bad it would get. Fear was everywhere. But investors who bought during that crash made extraordinary returns. The market bottomed on March 23, 2020. Over the next 12 months, the S&P 500 rose over 70%. Tech stocks did even better. Some stocks doubled or tripled in less than a year. Again, the investors who profited were not geniuses. They were not prophets who knew the pandemic would end quickly. They simply understood that crashes create opportunities, and they acted on that understanding. They bought when everyone else was selling. Now, I want to be clear about something. I am not predicting that a crash is coming tomorrow. I do not know when the next crash will happen. Nobody does. Anyone who tells you they can predict market crashes is either lying or delusional, but I do know with certainty that another crash will come. Crashes are part of how markets work. They have happened regularly throughout history, and they will continue to happen in the future. The question is not whether a crash will come. The question is whether you will be prepared when it does, whether you will have the capital to invest, whether you will have the knowledge to identify opportunities, whether you will have the psychological fortitude to act when every instinct is telling you to run. Let me talk about why crashes create millionaires, because understanding the mechanics will help you prepare. The first reason is mathematical. When prices fall, your dollars buy more shares. This is so simple that people overlook it. If a stock costs $100 per S-share and you have $10,000, you can buy 100 shares. If the stock crashes to $50 per S-share, that same $10,000 buys 200 shares. When the stock recovers to $100, your 200 shares are worth $20,000. You doubled your money simply by buying when prices were low. This math works even better with dollar cost averaging. If you invest a fixed amount regularly, you automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this lowers your average cost and increases your returns. During crashes, your regular contributions are supercharged because they are buying so many more shares. The second reason crashes create millionaires is psychological. Most investors cannot handle volatility. They panic when prices fall. They sell at the worst possible time. This creates opportunity for investors who can stay calm. Think about it this way: for you to buy a stock, someone has to sell it to you. During crashes, the people selling are often doing so out of fear, not rational analysis. They are selling because they cannot stand to watch their portfolio decline anymore. They are selling because the headlines are terrifying. They are selling because their neighbor told them to get out. When you buy from these panicked sellers, you are essentially buying their fear at a discount. You are taking the other side of an emotional trade, and over time, rational trades beat emotional trades. The patient investor who buys from the panicked seller almost always comes out ahead. The third reason crashes create millionaires is that they reset valuations to reasonable levels. During bull markets, especially long bull markets, stocks can become extremely overvalued. People pay 50, 60, 70 times earnings for companies because they assume growth will continue forever. These valuations are not sustainable. Eventually, they correct. Crashes are the correction mechanism. They bring valuations back to earth. They create opportunities to buy stocks at 10 or 15 times earnings instead of 50 times earnings. At these reasonable valuations, the expected returns going forward are much higher. You are not paying for perfection. You are paying a fair price for a good business. The fourth reason is that crashes shake out weak companies and strengthen strong ones. Not every company survives a recession. The weakly capitalized, the poorly managed, the structurally challenged. These companies often fail during downturns. But the strong companies survive, and they often emerge from recessions even stronger because their competition has been weakened or eliminated. When you buy quality companies during crashes, you are buying survivors. You are buying companies that have proven they can weather economic storms. These companies take market share from failed competitors. They acquire distressed assets at bargain prices. They come out of the recession leaner and meaner, positioned for years of growth. Now, let me talk about how to actually prepare for the next crash. Because understanding the theory is useless if you cannot execute when the time comes. The first step is building cash reserves. You cannot buy the crash if you do not have money to invest. This seems obvious, but most people ignore it. They are fully invested all the time. When the crash comes, They have no dry powder. I keep a significant portion of my portfolio in cash, specifically for crash opportunities. Yes, this cash earns less than I could make if I were fully invested in stocks. But that underperformance is the price of optionality. When the crash comes, I have ammunition. I can buy aggressively when others are forced to sell. How much cash should you keep? That depends on your situation. At minimum, you should have an emergency fund that covers 6 to 12 months of expenses. This is money you never invest, no matter how good the opportunity looks. Beyond that, keeping 10 to 20% of your investable assets in cash is reasonable. This gives you meaningful firepower without sacrificing too much return during normal times. The second step is building a watch list. You should know in advance what you want to buy during a crash. You should have a list of high-quality companies that you would love to own at the right price. You should know what price represents a good value for each company. When the crash comes, you will not have time to do extensive research. Prices move fast, opportunities appear and disappear in days or weeks. If you have not done your homework in advance, you will either freeze from indecision or make impulsive choices you later regret. My watch list includes companies with strong competitive positions, proven management teams, solid balance sheets, and histories of surviving past recessions. I know these companies, I understand their businesses. I have target prices where I want to buy. When the crash comes, I just execute the plan. The third step is psychological preparation. This might be the most important step, and it is the one most people skip. Crashes are emotionally devastating. You will watch your existing portfolio decline by 30, 40, 50%. You will read headlines about economic collapse. You will hear experts predict that this time is different, that the market will never recover, that everything you thought you knew about investing is wrong. In that environment, buying stocks feels insane. Every instinct screams at you to sell, to protect what you have left, to wait until things are clearer. Acting against those instincts requires preparation and practice. I prepare by reminding myself of history. I have lived through many crashes. Every single one felt like the end of the world while it was happening, and every single one was followed by a recovery. The market always came back. The investors who bought during the panic always made money. I also prepare by having a plan and committing to it in advance. I write down my strategy. I write down how much I will invest if the market falls 20%, 30%, 40%. I write down which stocks I will buy at which prices. This written plan becomes my anchor during the storm. When emotions are screaming at me to deviate, I look at the plan and follow it. The fourth step is managing your existing portfolio so it can withstand the crash. If you are using leverage, if you own speculative stocks that might go to zero, if you have concentrated positions that could collapse, a crash can be fatal to your finances. You will be forced to sell at the bottom to meet margin calls or prevent total wipeout. You will not be in a position to buy. Before the crash, make sure your portfolio can survive. Reduce or eliminate leverage. Diversify away from speculative positions. Own quality companies that will survive a recession. This does not mean getting out of stocks entirely. It means making sure your stock portfolio is resilient. A crash is only an opportunity if you survive it. If the crash wipes you out, there is no recovery. The first priority is survival. The second priority is having capital to invest. Both require preparing your portfolio in advance. Let me talk specifically about what to buy during the next crash, because not all stocks are created equal when the market falls. The best stocks to buy during crashes are high-quality companies with strong balance sheets that are selling at unreasonably low valuations. These are companies that you know will survive the recession, that you know will still be in business 10 years from now, but that are being sold by panicked investors who cannot distinguish between temporary price declines and permanent value destruction. I look for several characteristics. First, I want a strong balance sheet with low debt and plenty of cash. Companies with weak balance sheets can go bankrupt during recessions, and equity holders get wiped out. Companies with strong balance sheets survive and thrive second. I want a business model that can survive recession. Some businesses are inherently cyclical. They make money in booms and lose money in busts. These can be good investments, but they are harder to analyze and riskier to own. I prefer businesses with more stable demand, companies that sell products and services people need, regardless of economic conditions. Third, I want a history of surviving past recessions. Companies that made it through 2008, that made it through COVID, have proven their resilience. I have more confidence that they will survive the next recession too. Fourth, I want a reasonable valuation after the crash. Even great companies can be bad investments if you pay too much. During crashes, I look for companies trading at price-to-earnings ratios below their historical averages, at price-to-book ratios that imply significant asset value, at dividend yields that are unusually high because the price has fallen so much. Let me give you some examples of the types of companies I would buy during the next crash. Large-cap technology companies like Apple and Microsoft. These companies have fortress balance sheets with hundreds of billions in cash. They have products and services that people and businesses rely on every day. They have proven they can grow through recessions. During crashes, these stocks often fall 30 or 40%, along with everything else. Even though their businesses are barely affected, that is an opportunity. Consumer staples companies like Procter & Gamble and Coca-Cola. People still buy toothpaste and laundry detergent and beverages during recessions. These companies have incredible brand power and pricing ability. They have paid dividends for decades without interruption. During crashes, you can often buy these stocks at dividend yields of 3 or 4%, which is historically high for these quality names. Healthcare companies like Johnson & Johnson and United Health. Healthcare spending continues regardless of economic conditions. People do not stop taking their medications because there is a recession. These companies have diversified revenue streams and strong competitive positions. They often hold up better than the market during crashes, but they still get cheaper than usual. Financial companies like JP Morgan and Bank of America, but only if you have conviction in their balance sheets. Financials get crushed during recessions because people fear loan losses and bank failures. But the best banks, the ones with strong capital positions and diversified businesses, survive and take market share from weaker competitors. Buying quality financials during crashes can be extremely profitable, but you need to do your homework on their balance sheets. Industrial companies like Caterpillar and Deere. These companies are cyclical, so they get hit hard during recessions, but they are also essential to the economy. We need construction equipment and farm equipment. The best industrials have strong brands, global distribution, and recurring aftermarket revenue from parts and services. They survive recessions and come out stronger. Let me also talk about what not to buy during crashes, because avoiding mistakes is just as important as finding opportunities. Do not buy companies with weak balance sheets during recessions. Companies with too much debt can fail. Their equity becomes worthless. Even if the business survives, the equity holders might get wiped out through bankruptcy or dilutive capital raises. Stick with companies that have fortress balance sheets. Do not buy companies with unproven business models. Startups and speculative companies often look cheap during crashes. Their stock prices might fall 80 or 90%. But many of them will not survive. They will run out of cash. They will fail to achieve profitability. Their cheap stock prices will go to zero. Stick with proven businesses that generate real profits. Do not buy companies in structurally declining industries. A crash might make a dying business look cheap, but cheap does not mean good. If the industry is in permanent decline, the company is not coming back regardless of what the economy does. Avoid the value traps. Do not use leverage to buy the crash. This is the fastest way to turn an opportunity into a disaster. Leverage amplifies losses as well as gains. If you buy on margin during a crash and the market falls further, you can get margin called and forced to sell at the worst possible time. Use only cash you can afford to lose. Now, let me address the psychological barriers that prevent most people from buying during crashes, because this is where most investors fail. The first barrier is fear during crashes. Fear is overwhelming. The headlines are terrifying. The experts are predicting doom. Your portfolio is bleeding. Every instinct tells you that things are going to get worse, that you need to protect yourself, that buying more stocks is insane. This fear is evolutionarily programmed. Our ancestors survived by avoiding danger. When they saw a threat, they ran. This instinct served them well in the savannah. It serves you poorly in the stock market, because in the stock market, the moment of maximum fear is usually the moment of maximum opportunity. The way to overcome fear is to expect it and plan for it. Know in advance that you will be afraid. Know that the fear will try to prevent you from acting. And commit to your plan anyway. The plan was made when you were thinking rationally. Trust the plan even when emotions are screaming at you to deviate. The second barrier is uncertainty. During crashes, nobody knows when the bottom will come. Nobody knows how bad things will get. Nobody knows which companies will survive. The uncertainty is paralyzing. How can you buy when you do not know if prices will fall further tomorrow? The answer is that you never know when the bottom is. Nobody rings a bell at the bottom, but you do not need to buy at the exact bottom to make money. You just need to buy at prices that are cheap relative to long-term value. If a great company is trading at half its normal valuation, does it matter if it falls another 10% before recovering? Over the long term, buying at half valuation is a great deal, regardless of short-term fluctuations. The way to handle uncertainty is to buy in stages. Do not try to invest all your cash at once at the exact bottom. Spread your purchases over time. Buy some when the market falls 20%. Buy more at 30%. Buy more at 40%. This way you do not need to predict the bottom. You just need to have a plan for buying at various levels. The third barrier is social proof. During crashes, everyone around you is selling. The news is full of stories about smart investors getting out. Your friends and family are telling you to sell. It feels like everyone knows something you do not. But think about this. If everyone is selling, who is buying? The answer is that the wealthy investors, the ones who have been through this before, they are buying while retail investors panic and sell. Institutional investors and billionaires are accumulating positions. When the market recovers, these buyers profit while the sellers lock in their losses. The way to overcome social proof is to remember that the crowd is usually wrong at extremes. When everyone is bullish, it is usually time to be cautious. When everyone is bearish, it is usually time to be aggressive. The crowd follows emotions. You should follow logic. Let me close with a story that illustrates why crashes create millionaires. I know a man who inherited $100,000 from his grandfather in 2007, right before the financial crisis. His friends told him to invest it in stocks. His financial advisor recommended a diversified portfolio, but he was nervous about the market, so he kept it in cash. Then the crisis hit. The market fell 57%. His friends who had invested saw their portfolios decimated. His financial advisor was apologizing for the losses, but he still had his $100,000 in cash. At the bottom, in March of 2009, he finally got brave. He invested the full $100,000 in a simple S&P 500 index fund. He bought at the exact moment of maximum fear. Today, that $100,000 is worth over $700,000. If he had invested at the peak in 2007, it would be worth less, because he would have suffered through the crash and the slow recovery. By waiting for the crash and buying at the bottom, he ended up with substantially more wealth. He is not a millionaire yet from that investment alone, but combined with his other savings, combined with the returns compounding over time, he is well on his way. And it all started because he had cash available during the crash and the courage to invest it. That could be you. The next crash will create millionaires. It will transfer wealth from panicked sellers to patient buyers. It will reward those who prepared, who kept cash available, who built watch lists, who trained themselves to act against their instincts. You cannot control when the crash comes. You cannot control how severe it is, but you can control whether you are prepared. You can control whether you have cash to invest. You can control whether you have a plan. You can control whether you execute that plan when the time comes. The investors who do these things, who prepare and execute, they are the ones who come out of crashes wealthy. They are the ones who look back and see the crash as the best thing that ever happened to their finances. They are the ones who became millionaires, not despite the crash, but because of it. That is why I say with confidence that the next market crash will create millionaires. The question is whether you will be one of them. The preparation starts now. The opportunity comes later. And when it comes, you need to be ready. because crashes do not create millionaires automatically. They create millionaires out of the investors who prepared and acted. The rest lose money and watch from the sidelines as others get rich. Do not be on the sidelines. Prepare now, act when the time comes, and let the next crash be the foundation of your wealth. That is how millionaires are made, not in the good times, in the bad times. And the next bad time is coming. Make sure you are ready. Let me go even deeper on the specific strategies that have worked for me during crashes, because the devil is in the details. One of the most powerful techniques I use is what I call tiered buying. Instead of trying to guess the exact bottom, I set up multiple purchase levels in advance. I might say that if the market falls 20% from its peak, I will invest 20% of my available cash. If it falls 30%, I will invest another 30%. If it falls 40%, I will invest another 30%. And if it falls 50% or more, I will invest the remaining 20%. This approach has several advantages. First, it removes the need to predict the bottom. You are not trying to time the market perfectly. You are just buying more as prices fall further. Second, it ensures you have capital at every stage of the crash. If the market only falls 25% before recovering, you have still invested some capital at good prices. If it falls 50%, you have deployed even more at even better prices. Third, it provides psychological comfort. You have a plan, you know what you are going to do at each level. This makes it easier to act when emotions are screaming at you to run. Another technique I use is sector rotation during crashes. Different sectors fall at different rates during market sell-offs. Sometimes technology leads the decline. Sometimes financials lead. Sometimes energy or materials or consumer discretionary. By paying attention to which sectors are falling fastest, you can identify where the best opportunities might be. Generally, I look for sectors that are being sold off more than their fundamentals warrant. If technology stocks fall 40%, but the underlying businesses are still growing and generating cash, that is probably an opportunity. If financial stocks fall 50%, but the best banks have strong capital positions and will survive the downturn, that is probably an opportunity. The key is distinguishing between price declines that reflect real fundamental damage and price declines that reflect panic and fear. I also pay close attention to dividend yields during crashes. Many high-quality dividend-paying stocks see their yields spike during market sell-offs because the stock price falls, but the dividend remains stable. A stock that normally yields 3% might yield 5 or 6% during a crash. If the dividend is sustainable, that elevated yield represents a fantastic entry point. You are buying a growing stream of income at a discount. During the COVID crash in March of 2020, I watched dividend yields on quality companies spike to levels I had not seen in years. Procter & Gamble briefly yielded over 3%. Johnson & Johnson yielded over 3%. JP Morgan yielded over 4%. These were extraordinary opportunities to lock in high yields on stocks that had decades of dividend growth ahead of them. Let me also talk about the emotional journey you will experience during a crash, because understanding this journey helps you navigate it. The first phase is denial. The market starts falling, but you think it is just a normal correction. Markets correct all the time. This is nothing to worry about. You might even buy a little because you think it is a buying opportunity. Then the market falls further. The second phase is anger. Why did I not see this coming? Why did I not sell at the top? Why is this happening? You feel frustrated with yourself, with the market, with the news, with everyone who should have warned you. The market keeps falling. The third phase is bargaining. Maybe if I just sell now, I can buy back lower. Maybe if I hold on a little longer, it will recover. You start making deals with yourself, looking for ways to minimize the damage. The market keeps falling. The fourth phase is depression. This is the bottom. Psychologically, if not always in price, you feel hopeless. You feel like the market will never recover. You feel like you have lost everything. This is when most people sell. They cannot take it anymore. They just want the pain to stop. The fifth phase is acceptance. Eventually, if you can survive the depression phase without selling, you reach acceptance. You accept that the market has fallen. You accept that you have losses on paper, and you start to see the opportunity. Prices are low, companies are cheap. This is when buying makes the most sense. The investors who become millionaires during crashes are the ones who reach acceptance while still having capital to invest. They have survived the emotional journey without making panic decisions. They have held on to their cash reserves, and now they deploy that cash at the moment of maximum opportunity. I want to emphasize something important about this emotional journey. Everyone goes through it, even experienced investors, even billionaires. The emotions are real. The fear is real. The depression is real. The difference is not that successful investors do not feel these emotions. The difference is that they do not act on them. They feel the fear, but they buy anyway. They feel the depression, but they hold on. They follow their plan, even when their emotions are screaming at them to do something different. This is a skill that can be developed. Every time you go through a crash without panicking, you get a little better at it. You build emotional muscle memory. You learn that you can survive the fear and come out the other side. The first crash is the hardest. By the fifth or sixth, you know the drill. Let me also discuss some common mistakes people make when trying to buy the crash, because knowing what not to do is just as important as knowing what to do. The first mistake is waiting for all clear. Some investors tell themselves they will buy when things get better, when the economy stabilizes, when the news turns positive. But by the time everything looks clear, prices have already recovered. The market bottoms when things look worst, not when they look best. If you wait for certainty, you miss the opportunity. The second mistake is trying to pick the exact bottom. Some investors tell themselves they will buy at the absolute bottom and not a moment before. But the bottom is only visible in hindsight. You cannot know it is the bottom until the recovery is already underway. By trying to pick the exact bottom, these investors often miss the entire opportunity. The third mistake is going all in too early. The market falls 10% and you invest all your cash. Then it falls another 20% and you have nothing left. You are stuck watching better opportunities pass you by. This is why tiered buying is so important. Keep reserves at each stage of the decline. The fourth mistake is ignoring quality. During crashes, everything looks cheap. Terrible companies trade at seemingly attractive valuations. But cheap is not the same as good. If a company's fundamentals are broken, if it might not survive the recession, no valuation is cheap enough. Stick with quality even when junk looks tempting. The fifth mistake is using leverage. I cannot emphasize this enough. Leverage kills during crashes. You think you are amplifying your opportunity, but you are actually amplifying your risk. If you buy on margin and the market falls further, you get margin called. You are forced to sell at the worst possible time. No leverage. Cash only. The sixth mistake is neglecting your existing portfolio. Some investors get so focused on the buying opportunity that they forget to manage what they already own. If your existing portfolio is full of speculative junk, a crash can wipe you out before you have a chance to buy anything new. Make sure your existing holdings can survive the downturn. Let me talk about the specific numbers that would trigger my buying during the next crash. If the S&P 500 falls 15 to 20% from its all-time high, I start getting interested. This is a significant correction that often presents buying opportunities in quality stocks. I might deploy 10 to 15% of my available cash at this level, focusing on the highest quality companies that have fallen the most. If the S&P falls 20 to 30%, I get aggressive. This is a legitimate crash. Fear is elevated. Quality companies are trading at discounts that only appear every few years. I deploy another 20 to 30% of my cash at this level. If the S&P falls 30 to 40%, I get very aggressive. This is severe. There is blood in the streets. People are convinced the market will never recover. I deploy another 30% of my cash at this point. I have invested most of my reserves. If the S&P falls more than 40%, I deploy everything remaining. This is a generational opportunity. I might even consider reducing my emergency fund if I have other sources of financial security. These opportunities come once or twice a decade at most. Of course, these are guidelines, not rigid rules. The specific percentages depend on the nature of the decline, the valuations available, the quality of opportunities, and my overall financial situation. But having a framework helps me act decisively when the time comes. I want to close with a perspective that might seem contrarian. Most people see market crashes as disasters. They see them as threats to their financial security, as obstacles to their retirement plans, as events to be feared and avoided. And I understand that perspective. Crashes are painful. Watching your portfolio decline is emotionally devastating. The fear is real. But I have come to see crashes differently. I see crashes as opportunities. I see them as the market's way of transferring wealth from the impatient to the patient, from the emotional to the rational, from the unprepared to the prepared. Every crash I have lived through has made me wealthier. Not because I am smarter than other investors, not because I have special information, simply because I was prepared. I had cash available. I had a plan, and I executed that plan while others were paralyzed by fear. The next crash will be no different. It will feel like the end of the world while it is happening. The headlines will be terrifying. The experts will be predicting doom. Your portfolio will be bleeding. And yet, on the other side, there will be a recovery. There is always a recovery, and the investors who bought during the crash will be substantially wealthier. I want you to be one of those investors. I want you to see the next crash not as a disaster, but as an opportunity. I want you to prepare now so you can act then. I want you to build cash reserves, create watch lists, train your psychology, and commit to a plan, because the next crash will create millionaires. That is not a prediction. That is a statement of historical fact. Every crash in history has created millionaires. Every crash has transferred wealth from sellers to buyers. Every crash has rewarded preparation and punished panic. The only question is whether you will be among the winners or the losers. And that question is answered not during the crash itself, but in the months and years before, by whether you prepared, by whether you saved, by whether you educated yourself, by whether you developed the psychological fortitude to act against your instincts. Start now, the crash will come in its own time. But your preparation must start today. Build the cash, make the list, train your mind, commit to the plan, and when the crash comes, when everyone else is selling in panic, you will be buying with confidence. You will be acquiring quality assets at once in a decade prices. You will be laying the foundation for wealth that will compound for decades to come. That is how millionaires are made during crashes. Not by luck, not by timing, by preparation and courage and execution, by being ready when others are not. The next crash is coming. Be ready, and let it make you wealthy.